name's Zirpolo. I'm a junior in the program studying finance, and I cover the domestic consumer discretionary program or sector. When screening for a company, I wanted a value-based firm with fundamental ratios that were pretty low, as well as a company with an economic moat, i.e. a business segment that differentiates themselves from their competitors. So with that, I found Conn, ticker CONN. Conn operates primarily in two segments, retail and credit. The retail segment sells appliances, furniture, consumer electrics, and home office appliance accessories. The credit segment offers in-house customer credit options to consumers. Conn's operates 122 retail stores and is headquartered in Woodlands, Texas. Now onto my recommendation. Conn has experienced a 5-year sales CAGR of 11.3%, providing evidence that they can successfully combat e-commerce retailing giants. By offering next-day delivery and a low price guarantee on top-name brands in appliances, electronics, and mattresses, the company has been able to develop a retail segment that provides high value for low cost. So over the past few years, Conn has really sought to improve the credit segment. Evidence of that has been seen in their recent third quarter, with record yields and low charge-offs leading to the best third quarter credit spread in 5 years of 940 basis points. So basically, Conn provides different credit programs based off of like the consumer's credit score. This is new and relatively new, and this structure has led to a recent decrease in delinquency rates on credit loans, with 60-day plus delinquency rates declining 20 basis points in their third quarter, reflecting a 5th consecutive quarter of decrease. With a strong and profitable credit foundation in place, Conn is expected to expand their markets to the East Coast, with plans to open 7 new stores in 2019 and 12 to 15 in 2020. Finally, with the shrinking middle class, Americans are becoming more price sensitive, spending their disposable income on low-price items with high value. Due to Conn's ability to offer a low-price guarantee on top-name brands combined with the growing credit segment, it is recommended that Conn's Inc. be added to the AIM Equity Fund with a price target of $30.69, representing an upside of 31%. Due to the interest of time, I'm going to only say 2 drivers. So the first driver is credit in new markets. And during 2019, Conn's opened 4 stores in Virginia. Basically, the people in Virginia have, where the stores are located, have higher incomes and credit scores than the normal customers located in the South. This suggests that the company is targeting customers with higher incomes. By offering a low or no interest option financing program for customers with FICO scores above 650, Conn could increase revenue to their credit segment while also decreasing delinquency risk. And then my second driver, individualized products. Brick-and-mortar retailers have recently been overlooked, with most of the market viewing e-commerce as a threat to physical stores. By continuously changing their higher-priced product selection to be more individualized to the customer, Conn mitigates the risk to e-commerce retailers while still executing both on and offline. Due to the overall state of the market in Q4 and earnings miss and the threat of e-commerce taking market share, Conn is currently trading at a low price relative to fundamentals. With the ability to produce revenue while competing with e-commerce, Conn is a distinct advantage. Due to their large, well-established nature of Conn, this value play represents less risk than a possible investment in growth. And on to my valuation. In order to reach an intrinsic value for Conn, a 5-year DCF was constructed. Using a terminal growth rate of 2% and a WACC of 10.21, the intrinsic value of $29.05 was reached. Additionally, a PE multiple was calculated. Using a 29 estimate EPS of $1.58, and I utilized and a multiple of 1822, an intrinsic value of 28.83 was calculated. And finally, a historic relative valuation was conducted using a 15-year blended average of price to sales, price to cash flows, price to equity, and price to book, resulting in an intrinsic value of 37.53. And those 2 models were weighted 60/20/20. Coming up with a price target of 30.69. Conn is not played it. And due to the interest of time, I'm going to skip the risks and management and open the floor to questions.
All right. John, just in regards to, this seems like a very highly leveraged company, a lot more debt, and I know they had, looks like they have six amount of debt points to the case as well. Do you know why they're going on so much debt?
Yeah, well, they are a high debt firm. I I know that they have, like 80% of them are in short-term bonds and notes. But when you're dealing with customers with high, these customers are low to middle-class customers. Just so that the way that they're lucky, they need more debt.
Yeah, kind of going off of that, 2017, we see EPS go negative. I know in 2016 it wasn't. So what happened there, and why should we be concerned about that going forward?
Yeah, 2017, most of the stores were affected by Hurricane Harvey. Most stores are located in Texas. So same store sales for Harvey-related stores were down 11%, and that's a key metric to look at with retail. They expect those to increase as time continues. So, yeah.
So in your first driver, you mentioned those 4 locations,
Mhm.
and I was wondering how you kind of like modeled that in, considering that, or like if you took into consideration like the populations there and how many people actually have those credit scores.
Yeah, so I looked at just averages in the neighborhood or in the counties of each store. The driver really consists of it really relies on the credit spread and their goal of reaching 1,000 basis point credit spread. I guess I should explain this. Their revenue is breaking up into retail and credit. So if like you were to buy $1,000 washing machine through Conn, each customer, I think the average customer pays 17.8% interest on an item. So that'd be $178 going to the revenue of the credit and the principal of 1,000 would be going towards the revenue of the retail segment. So actually, most customers are using the in-house retail or in-house financing. It's 93% of all items are financed.
James, I know you touched on it a little bit, but can you talk about the different credit programs available and the percentage of that coming from each one?
Sure. Yeah. So if there is, there's different segments based on the credit score. There's no, you can receive no interest if you do have a higher credit score. There's lease to own as well. So Conn's through 93% of, like I said, mentioned before, 93% of Conn's product or inventory is credit is through in-house financing. 71% is through them. Of that 93, 71 is through Conn's. 19% is, or 16% is through a third party, and 6% is lease to own.
Yeah, on the credit also, on the credit side, first of all, did you do a sum of parts on the 2 segments?
Yeah, I currently did not. Going forward, I do want to integrate that into my model if I'm dealing with other retail.
Okay, and then still on that, with the low or no interest on FICOs above 650,
Yeah.
650 is still below
Yeah.
average FICO score,
Mhm.
so it doesn't worry you that they're not being compensated, or we wouldn't be compensated for taking on a risky investment.
Yeah, so if you don't pay, if you miss a payment, you do pay up to 29% APR. That's normal for a company that is dealing with. We have to remember that this company deals with customers that are lower to middle class. Their net yield is, as of Q3, was 19.3%, and their charge-offs was 15.1. So just the difference between that is where they're making their money.
Jerry?
Yeah, so another question about EPS. In 2019 and 2020, they're going up by around 50%.
Sure.
They're only seeing increases in revenue of 3 and 5%.
Sure.
So where are they getting those?
Yeah, so just with this company, you can see that it went from a negative 5% growth in revenue to 5% in 2020. That's really what drives EPS. I kept margins the same, or pretty consistent with cost of goods sold margin and SG&A. If you want to look at my model,
We'll do 2 very quick questions, right back here.
So kind of going off of that, you said revenues were negative last year. They've kind of been decreasing significantly since their high growth in 2014. At 38% growth in 2014 to -5 in 2018. Why are you projecting them to go back up to positive
Yeah,
3%, and why so low?
that's a good question. Obviously the hurricane had a huge, it caused a lot of problems with the company. I also feel that they now have a good foundation for the credit program, intact, and the fact that so many people use that in-house credit, financing program, I think that.
Thank you. Thank you. All right, staying right on schedule, we have Luke presenting next, is international healthcare stock. Okay, Luke, all set?
Hi, my name is Luke Smrek. I'm a junior at Marquette University. I'm double majoring in finance and economics, and I am the international healthcare sector analyst. Before I begin, I want to make a correction in my box. For short, so I put insider holdings, it should be 0.80%. So today I'll be pitching Hoya Corporation, ADR, ticker HOCPY. Hoya Corporation engages in the manufacture and sale of imaging and optical products, electronics, and medical-related equipment. It operates through two main segments, life care and information technology. The company makes electro-optical components used in high-tech and medical products. The life care segment, 66% of revenue, sells eyeglass and contact lenses, medical endoscopes, and intraocular lenses. The information technology segment, 34% of revenue, produces mask blanks and photo masks for semiconductor devices, LCD panels and optical lenses, and glass memory disks for hard disk drives and photonics. The company was founded in 1941 and is headquartered in Tokyo, Japan. Starting with my recommendation, Hoya Corporation is a market leader in eyeglass and optical products. It is poised to take a unique position in the industry as healthcare begins to collaborate with technology. Healthcare innovation is being driven by rapidly developing technology within the industry and to take patient care to a higher level. Hoya's two main segments, life care and information technology, complement each other as the company uses its IT segment to help improve the products within the life care segment. Hoya is now expanding its business fields from eyeglass and contact lenses to glass products for semiconductor manufacturing and for hard disk drives, HDDs. With increasing margin improvement in both segments, the company is investing in a new HDD production facility that will produce only glass substrate hard disk drives. Glass HDDs have shown positive effects compared to the normal aluminum HDDs. The glass expands less when heated and can tolerate thin and lighter hard drive platters due to its firmness, and it can be packed tighter. As a result of this, more platters can be added on the same hard drive, which results in adding 40% to the disk capacity, and with projections, Hoya will be creating a 20 terabyte disk. Hoya is looking to further increase their 14% market share globally as they look to continue to expand into the US and Europe by 6 to 8%. Their next generation HDD production facility will allow them to increase sales as they look to meet increasing global demand for 3.5-inch glass substrates. Due to low costs and high amounts of free cash flow, Hoya has the potential to increase profits in the life care segment from 8 to 10%, with continuing eyeglass and contact lens success and advancements within the healthcare industry. In 2018, the semiconductor industry grew by nearly 13%, which are crucial components of electronic devices, and by adding impurities, they can be customized to its conductivity. With Hoya ramping up production for extreme ultraviolet lithography, EUV masks and blanks, this provides a key opportunity to increasing sales as demand increases, and Hoya looks to improve their product by decreasing defect levels, which is one of the main challenges in the industry. Given Hoya's strong performance, favorable market position, and the integral part that the company will play within the technological medical field, it is recommended that Hoya Corp be added to the AIM International Equity Fund with a price target of $82.55, representing a 36.49% upside. Moving on to my investment thesis, my first driver is next-gen HDD production facility. So Hoya has started construction on a new production facility for hard drive platter glass substrates in Laos. Production will begin in 2020 and will be the third plant that produces glass substrates for hard drives. Hoya plans to boost production capacity on the prospect of future sales channel and volume increases. The facility will have advanced technology that will allow them to start producing 3.5-inch glass substrates for next-gen HDD media. The market for 3.5-inch drives has rapidly expanded due to increasing data traffic from companies such as Google, Amazon, and Microsoft, with demand estimated to grow by about 20%. With sales of high-capacity hard drives increasing, Hoya aims to boost its global market share for 3.5-inch glass substrates from 10% to 30% by 2021. Hoya is in a unique position to gain market share and lead the industry as no other company is producing next-gen glass or hard disk drives. Within the life care segment growth, eyeglass lens products dominate the segment and accounts for over 50% of sales. Eyeglass lens profits margins are moving upward year over year due to consistent sales increases and advances in efficiency. With demand for eyeglass lenses increasing by 3% globally and the worldwide aging population, Hoya will look to capitalize by filling these needs. Over the last year, the life care segment sales growth increased by 7%. Contact lenses grew by 8%, mainly due to continuing market growth in Japan. The growing level of nearsightedness among the younger generation and the rising age of those wearing contact lenses presents a strong opportunity for growth. Endoscope sales increased 16% year over year, with a 26% increase in Europe and 12% in the US in January 2019, Hoya completed acquisitions of ophthalmic medical device manufacturers, US-based MedLabs, and German company Fritz Ruck. Hoya looks to gain from this and is looking for major synergies from selling equipment with its own ophthalmic devices. My last driver is EUV mask and blanks. Masks and blanks experienced an increase in year-over-year sales growth of 27%. EUV sales and large-scale integration (LSI) masks have more than doubled due to intense R&D and now accounts for 23% of blank sales. Based on Hoya's EUV lithography next-gen manufacturing, circuits will become smaller, which will allow mass production and create faster and more powerful chips. With commercialization starting this year, growth will be expected to continue. Flat screen display, FPD, and LSI masks and blanks have tapped into the Chinese market this past year and have started to capture the strong demand for developing new FPD for smartphones. I'll now skip over my evaluation, risk, and management, and I'll open the floor to questions.
There we go. Go ahead, the first question, Eric.
So I noticed your company generates revenue in a lot of different countries. Is this transacted in the local currency? And then can you kind of touch on like currency risk they might face?
Yeah, so all my information is already exchanged into US dollars based on FactSet and my own currency exchanges. And did you ask about the risks regarding that?
Yeah, so like in these countries, do they transact in that country's currency or in US dollars?
Yeah, they'll transact in that country's currency.
So you're projecting like 7% year-over-year growth for the next couple of years, 7 and 8%. In your drivers, you're saying year-over-year sales growth was like 20%, like around the 20%. Is that for products specifically, for segments specifically? Like, can you like kind of touch on like
within
the
my
mix changing as well?
Yeah, within my drivers, those are for specifically the products and the segments. And in my forecast, I have that overall for the overall growth.
Are those profit margins real?
Yeah.
Wow. You guys look at those numbers? You see these numbers?
They have very low costs. Their cost of goods sold. Their cost of goods sold has actually been decreasing by an average of 5% every year. And so in my forecast, I actually have them increasing by 2%, just to be conservative. So
Yeah. Can you walk me through your 2019 EPS number? Because the street and the consensus the company gave was 289 to 287. So I'm wondering why you think there's going to be an earnings miss.
So why I had earnings lower?
Yes, from the company and the consensus on the street.
Yeah, I wanted to be fairly conservative with my first year out. Just basing off that, I wanted to be conservative with that, and also I had shares decreasing by a lower amount.
So related to your PE valuation, I see you use a blended weighted average. So can you just walk me through your comps and like why you decided to weigh them what they were, and then also what the value is for Viavi solutions, because it's not displayed in the box.
Yeah, so when I chose my comps, I looked at some of the main glass and eyeglass competitors around the world, and so those comps are their top competitors. The reason why Viavi I did not include them was they had a negative PE, so I didn't want that to drop any valuations there.
Yeah, it's more of a technical question, but, so it's currently trading right around like its highest it's ever traded. So I guess my question is just, does it worry you that you've seen it kind of run up like this and that maybe we could see it correct itself in the future and like just kind of going forward? How do you feel about that?
Yeah, I think it is around the highest we've seen now, but I think right now they're already producing almost like capacity with their sales consistent and constantly growing. And so with their new production facilities and their new products emerging in new countries, I think that that won't be a problem. I think that their stock price we will see them growing in the future.
All right, Luke, thank you very much, man. All right, now we get to look at a boat company, huh, Manny?
Can you guys see me?
We'll get your phone book.
Hi, everybody. I am Manuela Chaves. I'm a junior in the AM program. I cover consumer discretionary. And today I'm pitching Mary Max. And before I begin, I'd like to thank my mom for watching. And also, on my box, before I begin, in my box, under percent growth under operating income for 2018, that should be 39.5%. So Marine Max is the largest recreational boat and yacht retailer in the United States. With 36 locations in 16 states, HCL sells new and used recreational boats, including pleasure and fishing boats, as well as marine-related products such as engines, trailers, parts, and accessories. In addition, Marine Max provides repair, maintenance, and slip and storage services. The company also arranges boat financing, insurance, and extended service contracts. Recreational boats are manufactured by Brookfield Corporation, who is a world-leading manufacturer of marine products and goods. Marine Max also is the exclusive dealer for the Italy-based company, Vieth Group for mega yachts and other recreational boats for the U.S. The company was founded in 1998 and is headquartered in Clearwater, Florida. Now into my recommendations. Marine Max completed their IPO in 1998, and since then they have created a strong presence in the boating retail industry. They have experienced a 5-year sales CAGR from fiscal year 2014 to fiscal year 2018 of 14% and operating income CAGR of 33%. They have maintained operating and gross margins between 2 to 5% and 24 to 26% respectively. Through strong growth, Marine Max continues to enhance the position as the nation's leading recreational boat and yacht retailer. They have acquired 28 additional boat dealers, 2 brokerage operations, and 2 full-service yacht repair operations. In addition, the company has opened 34 new retail locations in existing airports. Many of the retail locations are waterfront properties on some of the nation's most popular boating locations, such as Chesapeake Bay, Tampa Bay, and Hudson. They have recreational boating in general has a natural appeal to consumers and will continue to grow under favorable economic conditions. Consumer preferences continue to skew higher in terms of price as buyers look for larger, feature-rich boats with greater horsepower. The total U.S. recreational boat industry generated approximately $39 billion in retail sales last year and is forecasted to grow from $42 billion this year. Although past hurricanes can seem like a hardship for Marine Max, they're actually the silver lining to which problems, as there's an applied unit upside of 50% from the replenishment of larger boats that were destroyed or damaged, as well as providing service for these boats. So, due to the stability of the large boat demand and healthy acquisitions and strong growth potential, it is recommended that Marine Max be added to the AIM equity fund with a price target of $24.25, representing a potential upside of 27.85%. Now onto my drivers, and now I'm going to highlight 2 of my strong drivers. Boat shows. Marine Max participates in boat shows and underwater sales events throughout the boating season. These shows generate a significant amount of interest in their products, which results in strong boat sales after the shows end. Q1 of fiscal 2019 included one of the best Lauderdale boat shows ever produced, as total revenue was up $5 million to $43 million. Over 100,000 people attend these shows, which helps increase Lauderdale boat sales. So Marine Max will be a part of over 30 boat shows in the upcoming boat season, which is more than they have been in the past, and they will be innovating newer models, which will be highlighted, which will help boost revenues and earnings. Hydrogen 2.0. A license agreement was signed between Joy Scientific and Marine Max on September 2018, granting Marine Max the right to develop, manufacture, and sell propulsion and auxiliary boat power systems capable of running on hydrogen extracted from seawater using their technology. Hydrogen technology will allow Marine Max to power boats, yachts, and ships using direct combustion, hybrid electric, or fuel cells to convert the hydrogen to power. HEO's strategy to expand to sustainable market will aid in addressing the changing consumer desires given the increase in demand for sustainable systems and products, which represents a substantial growth opportunity for the company. And now into my evaluation. In order to reach an intrinsic value for Marine Max, a 5-year DCF model was constructed. Using a terminal growth rate of 2% and a WACC of 8.09% with an intrinsic value of $24.25 per share. A sensitivity analysis on the terminal growth rate and WACC ranged from 1961 to 3201. In addition, a PE multiple was calculated. Using fiscal year 2019 estimated EPS of 191 and a blended peer average PE multiple of 1069, I calculated an intrinsic value of $20.46. Lastly, an EV/EBITDA multiple was conducted using a blended peer average EV/EBITDA multiple of 1089 and a fiscal year 2019 estimated EBITDA of 8155, creating an intrinsic value of $20.47. So I weighed them 30, 34, 30, 33 respectively, and I got a price target of 24.25, which resulted in a potential offset of 27.85%. And then Marine Max does not pay the dividend. And in the interest of time, let's get my recommendation.
All right, let's do some questions. Eric?
So you mentioned this company will continue to grow under favorable economic conditions. Consensus from economists are basically predicting slower growth. So is now really the best time to buy a boat company who generates the majority of its revenue from new boat sales?
That's fair. So the question was in regards to in the future, in the upcoming season, that economic conditions are going to be slower. So with the analyst reports, sell side reports, and the way I'm more of an optimistic person for economic conditions. So I do believe that Marine Max there will be greater demand for boat season this upcoming season, as management does in our analyst report. So I think it would be a good time to buy Marine Max now.
Ellen?
So in your recommendation, you said that they've maintained operating margins between 2 and 5%, but then in your box, you were projecting them to go above the 5% and even almost to 6%. So I guess I just want to know why you believe that.
Yeah, so I did that because they did have in 2018 they had more selling SG&A because of the acquisitions that they were having, another an insurance cost. So I did decrease SG&A a little bit to increase my operating growth or margin because I do believe that eventually it will get higher.
Derek?
So the hydrogen 2.0, it seems like a pretty strong opportunity for the company. Do you have any figures about how it might boost revenues or market share?
Yeah, so it was interesting to model just because they didn't give me any specific numbers because it is so new. But I do believe that it will eventually boost revenues in 2019 if it does if they do develop it, because it's not for sure that they will, but we're hoping that they will. And I do think they're going to gain market share because they're going to become an eco-friendly market, and then more people are going to want to buy eco-friendly boats. I don't know if that answers the question.
Thank you.
Edward, back there.
Hi, I was just wondering if you could talk about maybe 2022 and onward of the revenue percent growth and then the operating margin in the future too. I'm struggling to see whether this is a growth play or value play. Seeing a decrease in margins from 5.8 to 5.7 and then just slow growth lower than the 7% and the 11% I've seen in the past.
Yeah, no, so I was really conservative when I did my revenue growth just because I feel like I was a little too unfair for this company, and maybe we could have seen better like 7 or 8%. But on forward, I did just a steady 5 and 6%. But I did decrease my SG&A because they are getting better with decreasing their SG&A, which does present higher margins.
Yeah.
Right, so for the EV to EBITDA, you included CarMax. It looks like, did you include CarMax in your PE valuation? Your average?
I included it.
You did include it? So what happens if you exclude it the same way you did the EV to EBITDA? What does it do to your price to earnings? So if you were to add that one in,
Yeah.
or if you were to
So
take that one out.
exclude it. Well, if I exclude it, it definitely increases my upside. I don't have the number for you, but because it is a higher TD.
Okay,
But I mean, I can go back to you.
Okay.
and figure
yeah,
it
that
out.
works.
We have just a couple of minutes, three real quick questions. Michael, you've been patient. Go ahead.
Your first driver is boat shows. I would have to assume maybe you answered this in your boat shows. But I would have to assume that most like competitors go to boat shows. Can you just elaborate on how marine bags how that differentiates?
Yeah. So as I said before, they are going to have more boat shows this upcoming season. And because they are the largest dealer, they have more companies that represent them, which, so there are more companies that consumers will see, and that's why I think that it'll be higher for them.
Connor, real quick.
For the 60% of the boats that were damaged, that they go take advantage of, how many of these boats do you expect the company to get advantage of or reselling? Do you have a percentage that you think it'll be at, or do you model that in at all?
Yeah, I said about 200,000 to 300,000.
Okay.
Bill, last question.
Sea Ray is closing their doors, and not closing their doors, they're only selling less than 40 feet. It's the largest revenues coming from Sea Ray. Can you comment on how, what the impact will be going forward?
Yeah, so Brunswick Corporation, their division is Sea Ray Yachts and Boats, and they stopped, Sea Ray stopped selling their stuff with them making yachts. And in a way, this actually is a little better for my company because 40% of my revenues do come from Brunswick Corporation. This does decrease that risk that's going to a large vendor. And they are trying to fill that, they are going to fill that void with the Zanetti group yachts, which are Zanetti group. Yeah, I put on the picture.
All right, man. Thank you very much. All right, Brandon, we're gonna have a international real estate Colliers. All right, Brandon.
All right, thanks for coming out today. My name is Brandon Shanklin, junior at Marquette, double majoring in finance and real estate. I'm responsible for the international and domestic financial services as well as the international real estate. Today I'll be pitching to you guys Colliers International. The Colliers International Group is a full-service international commercial real estate firm founded on July 31st, 1988, and is headquartered in Toronto, Canada. The company offers services including outsourcing and advisory services, lease brokerage and sales brokerage, and most recently, investment management services. Its segments include Americas, Europe, Middle East and Africa, Asia Pacific, and corporate. It is engaged in the transaction brokerage business, which provides services in sales and leasing for commercial clients. It also provides services for sales, leases, and mortgages in various areas such as landlord representation, tenant representation, and capital market and investment services. Now moving on to my recommendation. Since separating into two independent companies from First Service Corporation in 2015, Colliers has experienced a 4-year sales CAGR of 13.18% and operating income CAGR of 13.11% and has maintained gross margins around 32% to 37%. Also, right after the separation was complete, Colliers announced and implemented an Enterprise 2020 plan, which called for a doubling of the company size by 2020. Part of this plan included 5% internal growth and 10% growth through acquisitions through 2020. Part of this plan last year, Colliers completed 11 acquisitions, including the major acquisition of Harrison Street Capital, focusing their inorganic growth in 2018 to be a part of their investment management service, giving Colliers the ability to spread out risks throughout these acquisitions. In 2018, in the Americas, revenues were $475 million, up 14%, comprised of strong internal growth of 9%, along with 5% contribution from acquisitions. In EMEA, revenues of $217 million in the quarter increased 21%, with revenues up 6% internally compared to Q4 last year, and 15% from acquisitions completed earlier. When it comes to debt and creditability, Colliers has a lot of room available, with an expansion to a $1 billion revolving credit facility that they have access through mid-2023. With the stability of real estate services needed, a strong acquisition strategy, and market share up for grabs, it is recommended that Colliers International Group be added to the AIM Equity Fund with a price target of $81.78, representing a potential upside of 17.62%. Now moving on to my drivers. My first driver is their Enterprise 2020 plan. Like I mentioned previously, in 2015, Colliers announced its implementation of the Enterprise 2020 plan. Since then, the company has completed over 40 acquisitions with most focused on strengthening its offerings and capabilities in the US and EMEA. A part of this plan, Colliers completed a record 10 other acquisitions in 2018, excluding their Harrison Street acquisition, including 5 in the Americas, 4 in EMEA, and 2 in the Asia Pacific. All of these maintained Colliers pace as the world's fastest growing global real estate and investment management firm. This plan and goal for continued inorganic growth will continue to diversify revenues and risk across all regions and service lines, better positioning Colliers to cross-sell services, which will make 2019 and 2020 successful growth and productive years for Colliers. My second driver is their PropTech Accelerator program and their new technology. Colliers has partnered with Techstars to create the PropTech Accelerator program, which focuses on solving problems across the property and commercial real estate industry. Through PropTech, Colliers has engaged in joint ventures with 3 startups so far, increasing their technological capabilities and data computing analytics. Also, Colliers' CapEx in 2018 was $35.6 million, but in 2019 it is forecasted that Colliers will have $45 million in CapEx, which is a 26% increase, which will be used exclusively for technological enhancement, according to their CEO, Jay Henry. This will substantially make business better to create more data for Colliers as leaders and create much more data for clients to make decisions out of the field. Colliers also hired Jake Edens as its new head of technology and innovation strategy, which Edens is the founder of Rescore, which is a platform that utilizes proprietary market analysis based on data aggregation to help commercial real estate professionals make better decisions. And since then, Colliers has implemented the Rescore platform. My third driver is Harrison Street. So Harrison Street Capital, which is a recent acquisition of Colliers, recently established an infrastructure open fund, raising about $500 million, in which they have a pipeline of transactions focusing on student housing and medical offices, which are 2 sectors that are growing significantly in infrastructure. Colliers has assets under management of $26.4 billion at December 31st, as of the end of last year. Along with this investment management service that was acquired comes stable and recurring fee revenues in the future, which is anticipated to be a platform for growth globally, both internally and through acquisitions. It leads Colliers now being able to use its in-house services for their investments, increasing efficiency and adding more durable cash flows in the future. Colliers now has untapped potential into Harrison's portfolio, and this strategic acquisition will lead to seamless vertical integration of Colliers' business operations into Harrison, such as property management and leasing, as Colliers is now able to use its services on these assets. Now, to save some time, I'll skip my valuation and move on to some of the risks. Some of the risks are, the first one is geopolitics, specifically Brexit. Because of geopolitical changes that are going on in Europe, specifically Brexit, and the reaction of various other countries in which Colliers operates has led to a slowing down in internal growth in Europe. Sales were down sharply in the UK in Q4, but also leasing activity were down pretty sharply as well. Where a number of their clients are just waiting around and are pretty indecisive, so they took a pretty big hit. This shouldn't be a major issue though, because I believe the Brexit issue will be resolved fairly soon. My second risk is high debt. Colliers, through its Enterprise 2020 plan, has been funding its acquisitions through taking on more debt. The risk is them not being able to produce enough cash flow and have the ability to pay off their debt. They have an equity multiplier of 6, which is pretty high. The debt taken on has been focused for acquisitions and effort to grow the business, but with this much debt, the company becomes much more at risk of bankruptcy if not handled the right way. I'll also be skipping my management, so I'll open up floors
All right,
to
questions from the floor. Eric.
So the first 2 of your relative valuation models say that the company is overpriced, and then can you kind of comment on your EV to EBITDA, because it makes me believe that the upside from this multiple is coming from all their debt. Can you kind of comment on that?
So yeah, in my boxes, a lot of the stuff is, or my 2019, 2020 forecast can be a little bit skewed. When it comes to EV to EBITDA, I used my EV to EBITDA valuation because, for one, I wanted to compare it to my comps when it came to DNA expenses, just because with acquisitions we'll be taking on, or with this increase in assets under management, we're exposed to more depreciation expenses. So that's why it kind of manipulates our like margins in like 2019 to 2020. But yeah, so
Nick, and then Derek.
So I noticed that the spread on your sensitivity analysis is pretty wide. Can you tell me what the basis point change was? there?
Yeah, so my basis change in sensitivity analysis was 0.5%.
25 basis points.
0.5%.
Oh, sorry.
0.5%.
All right.
So it's pretty sensitive.
And then what was the weights on your
My weight.
No.
So I did 60% on my DCF.
or on
well,
your comps? So you used a weighted average, right?
Yeah. Well, yeah, it was even.
Oh, I thought you used like a weighted average on your comps, like or did you weight them all equally?
Yeah, I weighted them all.
Oh, my bad. I read that wrong. Okay, yeah. Thanks.
Derek.
That was my question.
Okay, Connor.
Yeah, so when Colliers looks for properties, so when Colliers looks for properties, what kind of areas do they target? Is there a specific, want a city? Is there like certain growth rates they look for? And how do they? Yes, how do they go about that?
Yeah. So well, with their acquisition of Harrison Street pretty recently, I don't have enough or not a lot of information on what specific properties they're targeting, just because Colliers is a service. They are a service company, so they're not necessarily targeting properties. They're doing their services through, whether it's commercial or industrial. They shy away from residential just because that's why they separated from First Service Corporation in 2015. But now with their new investment management service, I couldn't really tell you much about their plan and what specific type of property.
Can you talk to me a little bit about why you chose CBRE Group as a comp? And did you look into like Walker and Dunlop or JLL just because their market cap is so much larger and Walker and
So
Dunlop
I chose my peers just by looking at like the industry and just looking at how competitive they are towards Colliers. I chose CBRE just because it is a pretty big company. It's probably the leader in sales when it comes to that industry. So I thought it was pretty fair to include them just as them being the leader. But I chose my peers just because it was a pretty good mix of competitors, and I also included Newmark and Cushman & Wakefield just because they have reputable and they pose competition.
All right, we have one more question. Connor.
Can you talk about how you got to your 20% revenue estimate for 2019 when the company gave guidance of high single-digit revenue growth from that year?
Okay, so they gave guidance of high single digits. Okay, so the reason I continued on to the high growth was because in 2018 we had a growth of revenue growth of 24.17%. So I wanted to remain pretty high or be conservative with that, considering our enterprise 2029 isn't over with, and they do still plan on using I think it was 10% of the EBITDA to do for acquisitions. So I feel like through these acquisitions, we can replicate it through the year 2018. So I thought it was pretty generous.
Thank you, Brandon. All right, we're kind of on schedule, aren't we, Matt?
Yeah.
Do the best you can. We have about maximum 10 minutes.
All right, I will try to be quick. So I am Matthew Vieth, and I am a junior in the AIM program covering the financial services and the real estate sector. My company, Brookfield Renewable Partners, owns, operates, and develops renewable power generation facilities and operates through 4 segments: hydroelectricity, wind, solar, storage, and corporate. It operates 840 generation facilities using these technologies. On to my recommendation, Brookfield Renewable Partners has created strong return growth and income for investors since its inception in 1999. The company has delivered 15% per unit compounded annual total returns to unit holders, which is ahead of the S&P 500's 5% annualized total return. Brookfield Renewable Partners' stated objective is to deliver long-term total returns to its investors 12 to 15%. 3 factors powering Brookfield's Renewable Partners company's performance is first, their attractive dividend current yield of 6.9%, their expected organic growth of 6 to 11% per year over the 5-year holding period, and finally, the company anticipates that its increasing cash flows will continue to support 5 to 9% annual dividend growth. The company's management remains open to future acquisitions, and given their past success in acquiring and managing assets, future earnings growth rates could be higher. For instance, last year BEP Management invested $420 million to increase its stake in wind and solar power company Terraform Power. That transaction helped Brookfield Renewable Partners grow earnings by 14% compared to 2017's levels. Continuing to seek new acquisitions as it forecasts that the world needs to invest roughly 10 trillion into building new renewable energy assets to help meet the global economy off fossil fuels. In BEP's view, it should easily be able to invest $700 million per year to acquire high-quality renewable power assets from developers, in addition to adding capacity with existing projects. Given this, it is recommended that Brookfield Renewable Partners be added to the main international equity portfolio with a price target of 40.31, representing an upside of 32.76. On to my drivers. Increasing demand for renewable energies. Demand for renewable energies continues to grow around the world due to its positive environmental profile, the benefits of supply diversification, and its increasing cost competitiveness with traditional technologies. By the end of 2016, global installed renewable power capacity exceeded 1,800 gigawatts, and total investment in new clean energy facilities in that year is an estimated around 280 billion, increasing capacity of approximately 150 gigawatts. Continuous improvement in technology and economies of scale continue to reduce the cost of renewable power. On to my next one. Global scale and geographic diversity. With a portfolio of assets in North America, Europe, Colombia, and Brazil, Brookfield Renewable Partners has diversified their cash flows, which increases their economic stability and lowers cost of capital. Diversification, along with strong institutional relationships, gives BEP access to capital across geographic markets, enabling them to take advantage of attractive opportunities as they arise. This creates opportunities for investors to achieve capital gains because as BEP continues to diversify internationally, they achieve a competitive edge over competitors that have little experience in these areas. These barriers give BEP a moat from their competition and high expected returns in long-term contracts in emerging markets with high growth / revenue opportunities. Lastly, strong acquisitions. BEP continues focusing on long-life renewable power assets to provide stable, long-term contracted cash flows, which are acquired on a value basis and located in high-value power markets where rising power prices offer strong prospects to generate growing cash flows and can appreciate in value over time. BEP has been and continues to make acquisitions of these types of high-quality assets. In March 2017, BEP went into agreements with Terraform Power and Terraform Global to acquire 51% interest in Terraform Power and 100% interest in Terraform Global. On my evaluation, 3 models were created to reach an intrinsic value for Brookfield Renewable Partners. First, a discounted cash flow was conducted using a WACC of 7%, which generated an intrinsic value of 33.11, yielding a 9.06 upside. Furthermore, a 5-year dividend discount model using the cost of equity of 8% produced an intrinsic value of 39.62, resulting in a 30.5% upside. And finally, a price of sale model was used to value Brookfield Renewable Partners compared to its peers, generating a value of 51.48, representing an upside of 69.56%. By weighing the 3 models, 35, 40, 25 respectively, a price target of 40.31 was reached, resulting in a 32.76 potential upside. Brookfield Property Partners current dividend yield of 6.9%. Now let the open.
All right, let's start with Edward.
For your box in the front, honestly, I really want to know all these stats outside of 2019. I don't really care too much about 2016 and 2017. Do you have the numbers with you for 2020 and maybe even 2021?
I don't have them currently on me, but they are expected to grow going forward given their increasing acquisitions and lower costs from overtime.
We got Sean here.
So you said first of all, their debt to equity ratio compared to their companies is very high. It's very high. Are they using this debt to finance these acquisitions?
Yeah, so they use their debt to finance these acquisitions that they've been making and their projects that they've been creating over the past 5 to 7 years. But going forward, they plan to use excess retained earnings and revenues to finance any future growth and projects.
Robbie.
So they're using their revenues to their growth? I mean, in 2019, you have their revenue growth going negative. And where do you see that going on in 2020, 2021?
Well, a big part of that going forward is that the purchase of Terraform is going to diversify their revenue streams greatly from hydroelectricity, really much more into solar and wind. So going forward, that's going to be really huge to keep increasing revenues. And as the management stated, they plan to keep returns at, or aim to have returns at 12 to 15%.
Yeah, the WAC seems really low considering where they make their revenues. Just 30% from Colombia and the base contributed. Did you use a country risk premium in that WAC calculation? And did you do a sensitivity on it?
I did not actually use a country risk premium, but what I did was, in addition to my calculation, I weighted it with, or I looked at the consensus of other markets, and actually, I think it was FactSet and both Bloomberg have the actual WAC around about 6% to 6.25, but I wanted to have a more conservative estimate, given your concern at 7%.
Okay, any hands up? Who else? Questions? Right here,
What's your terminal growth rate on your discount model?
Terminal growth rate was, I believe, 3%, or, sorry, I don't.
I need to check that.
Yeah, I need to.
Okay.
Questions? So they own lots of properties. These are wind farms, solar farms, what else?
So yeah, wind, solar, the hydroelectricity makes up the majority of their revenues at around 65 to 60%. And then growing in the future will also be biomass energy.
So they're not actually a utility, but they own the properties, they operate them. I mean, how do they get their revenues?
From the cash flows generated by selling the electricity to local governments, regions, areas, and facilities.
That's a very impressive dividend, 6.9%. What's been the history of that?
Starting out, they always wanted to have a high dividend and just increasing cash flows. So from the start, they attempted to keep that high.
Bill, last question or comment?
Just a comment. When you're this afternoon, when you're presenting strong, it's a big room. Make sure you really are strong voice. Project. So that's all I have to say.
All right, Matt, we're right on schedule. Thank you very much. Okay, so those of you going to Wells, come on up. We got to talk about the logistics, okay? Come over by Bill and my desk over here.
Yeah.